Good afternoon. It's 3 o'clock on March 16th, and the Dow just closed down 3. Of today's video is to compare previous crashes to what we're going through now. So let's look. I mean, in 2000 we went through the .com, and from the top to the bottom was what, 3 years? So that was a gradual slide. During that time, you could take appropriate measures to readjust your portfolio and your assets to mitigate the downturn. Now let's look at how long it took it to recover from the low. So if the low is right here in 2003, it took 4 years to get back to where you started. So now let's look at the financial crisis. It started out as a high, just about where it was in 2000, and then dove down. It took 2007 to 2009. So it took 2 years to get to where the bottom was. 2 years, okay? And that was a financial crisis, and there were runs on the bank, but a financial crisis, as bad as it was a known problem with known things you can do to fix it. So now, how long did it take to get us back from the financial crisis? Our low was 2009, and it was 2013. Yet another 4 years recovery. So these are not V recoveries; they are slower recoveries, and stocks coming out of these from the bottom to here were not the same ones that were the ones in vogue before the crash. So your portfolio going into a crash may not look anything like your portfolio coming out of a crash. Therefore, what I'm trying to say is you got to raise cash, because if you had 50% cash at the bottom of this, your portfolio would be 50% recovered. I mean, you'd start at the bottom at zero and you would ride this up. Whereas if you didn't have cash, it would take you this long to get back, if you got back, because the stocks that you had may not have been as good as the stocks you're going to need to get back where you were. But this is the S&P, so if you just stayed in the S&P, it would have taken you 4 years. Now let's look at where we are today. We have gone farther down than any of the previous crashes in 2 months, not 3 years. So to put things into perspective, this is going down very quickly. And I think it would be wise to have cash to invest when the market does turn. And the difference between the financial crisis, we had people going to the bank to try and get their savings. We had runs on the bank. We had things like that. But with the coronavirus, we got to have people runs on the supermarket, and they're worried about whether they're going to be eating next week. So the actual mindset of this one is considerably more fearful than the other two. So I think that's one of the reasons it's going down so fast. And then let's talk about possible recoveries. This is like a wave. It started off in China, and we didn't care much about that. Nothing happened to the market. But when it started expanding, all of a sudden it got our attention. Now we're doing all sorts of things to stop the virus, as far as shutting things down, shutting off our borders, and all this is really maybe good for stopping the coronavirus, but it's suicide for economies. So because everything shuts down, you look at the like the cruise ships. I mean, those things are expensive, and life was good for them. They'd fill them up with 3,500 people. They have a huge debt load, which they were servicing well. Now all of a sudden, their cash flow didn't just come down a little bit; it went off a cliff, and they don't have cash flow because they're not sailing because they have to sit out the coronavirus. Likewise with dividend stocks. You look at, there was a great dividend, still is or was, Disney. Oh my gosh, they were like a dividend aristocrat, and life was good, and they had theme parks, and they had movies, and they had all this wonderful stuff. But now, you can't go to the theme parks. You can't go to see the movies. So their cash flow is going to drop off a cliff. So it's not going to be panacea like I'm going to have dividend stocks and they're all going to come back. I don't think so. I don't think that's going to be the case. You're going to have to sit this one out, and I don't know how long or how far that's going to be, but you're going to be better off in bonds and cash than you are in equities. The other thing you should consider doing is reallocating your 401k and go really conservative, like with bonds, like intermediate bonds or any kind of bonds, because as they lower interest rates, which they have, theoretically bonds will climb on that. But with this market, who knows? But we're already at zero, and so what's going to happen is fixed income may be a myth, because if it was zero interest, there's not going to be any income on the fixed part. So what do? First of all, raise cash. Go to like 20 to 30 to 40% cash and wait and set it out. So when this does turn, you're starting at the ground floor with your investments and not with a huge loss on the things that you have. Reallocate, like I said, reallocate to really conservative and reallocate your 401k. Don't count on a V recovery. Each time before this, it was like 4 years. So if you consider that a V recovery, then that's what you're probably going to get. If it's even 4 years, it may be longer. Prepare to arrange your portfolio for the recovery. It's going to come. We just don't know when. And then watch out for dividend stocks. And one of the things I think is really making this worse is in the last couple of years. Remember the S&P had a put. I mean, it wouldn't go down. Everybody bought the dip, and it's my opinion that it was foreign money coming in because there was no place else to invest globally. So all this foreign money was pouring into the U.S. stock market. Now all of a sudden, I think that foreign money is going out, and to what extent they floated the stock market, I think it's going to also have an effect on the decline. So be careful. This market is working to figure out, and the market and the country, trying to figure out what we're going to do with this virus. The idea floated out of just shutting everything down and quarantining everything for 14 days initially sounded stupid to me, but if you can break the cycle of contagion, it may actually be not that stupid. But anyway, I don't know where this is going to stop. I do have experience in 2007, 2008, and this is worse. It's going down faster, and everything is being hit, and the runs are now in the supermarkets, but not the banks. So I'll leave you with that thought. If you like what I'm saying, please hit the subscribe button, and I hope we get better and things start working out better soon. Thank you very much for watching.